Hello friends, we are going to see what is meant by liquidity adjustment facility of Reserve Bank of India. But before going to that, it is very important to know what is meant by liquidity. The standard definition of liquidity is a measure of ability and ease with which assets can be converted to cash. This definition is difficult to understand, but to make it easy, we should break it in parts. First, this definition is talking about assets, both tangible and intangible assets. Second, liquidity is a measure of ability and ease of assets. Thus, liquidity is a measure of ability and ease, right? We know that centimeter is a measure of length. In the same way, liquidity is a measure of ability and ease of assets. Ability and ease for what? Ability and ease of asset to get converted quickly into cash. So the ability and ease to get converted into cash. Now suppose if we want to measure liquidity, we can just measure by calculating time needed for an asset to get converted into cash. If we want to convert a particular asset into cash, we need to sell it, right? But if we have a cash in our hand, we need not to sell it to anybody to get cash back, right? Just cash itself is a cash, so it needs 0 second to get converted into cash. So cash is the most liquid asset. If we calculate the time required for gold to get converted into cash, then it could be in minutes, because we can go to any gold seller, and if we ask to purchase the gold, he will purchase it, right? So in minutes we can convert gold into cash. Suppose we want to sell our house or car to convert it into cash, then it requires months to do the transaction. So gold is having more liquidity than house or car, and cash has more liquidity than gold. So in this way we can categorize any asset on the basis of liquidity, and then we can convert them into cash. I hope this clears the concept of liquidity. Now we are ready to get deeper into the concept of liquidity adjustment facility. For that, we need to visualize a bank. For any bank, there are some liquidity obligations. This liquidity obligation could be categorized into 3 parts. First part is liquidity obligation by RBI. RBI has set up some cash reserve ratio norms and statutory liquidity ratio norms. So bank need to maintain the liquidity for this. Second is that bank need to fulfill the demands of saving account and current account customers. If they demand cash, then bank has to fulfill that. Then if the term deposit like fixed deposit and recurring deposit, if maturity of fixed deposit is nearby, then banks need to have the cash for fulfilling this requirement. Then bank need to run their business, so bank need to maintain the staff, bank need to pay the utility bills, so that also require cash. And apart from that, bank need to give the loans to the customers so that bank can charge interest on those loans and earn the profit. So these are the liquidity obligations for the banks. In simple term, we can call this as a cash demand for the bank. So bank has some cash demands, and bank has some cash supply in the form of deposits, be it a current deposit, be it a saving deposit, be it a fixed deposit or a recurring deposit. In this form, bank generate the cash supply, right? So 2 things are clear here, that bank has cash demand and bank has a cash supply, and bank need to balance these 2 things. Bank need to balance the demand with the cash supply. So that is very important for bank to maintain the health. We will call this as a normal situation where bank is able to successfully fulfill the demand of the cash with the supply of the cash. But there are two extraordinary situations. One is the cash surplus or liquidity surplus, and one is the cash crunch or liquidity crunch. Liquidity crunch is the situation where the demand for the cash is more than the supply of the cash. Now, how to deal with the situation? To deal with the situation, RBI has introduced the liquidity adjustment facility, where they have provided the repo or repurchase option to the bank, where bank can get a collateralized lending from RBI, but the bank has obligation to return back this money to RBI at the predefined date and at the predefined rate. So bank can manage their liquidity, short-term liquidity, by making this arrangement, and this is known as a repo option. The similar option is available to deal with the liquidity surplus, because liquidity surplus is also harmful for the bank, because if there is a surplus amount with the bank and it is idle, there is no benefit or interest bank can get out of it, because bank has assured the customers to give the fixed interest rate on saving account, some fixed interest rate on the fixed deposit and recurring deposit. So if bank cannot deal with the surplus, in this case the bank can take the reverse repo option, where RBI borrows the money from the bank by lending the securities, and RBI can provide this to any other bank which is in the liquidity crunch. The benefit for RBI through this is that reverse repo rate is always 1% less than the repo rate, and by taking out money from one bank and by giving it to other bank, RBI gets 1% interest. So that 1% is very important. By just doing providing the service for this, RBI is getting the 1% interest rate. So this is very beneficial for RBI. It is very important for the bank in the liquidity surplus and for bank in the liquidity crunch. And this tool of a repo and a reverse repo, known as the liquidity adjustment facility, is very important because RBI can manage the inflation, though on the short term basis. One more information I want to give here is that earlier this repo option and reverse repo option was of 14 days or 7 days. It is a very short term measure, and RBI can use it to control the inflation on the short term basis and help out the banks to effectively deal with the liquidity surplus and liquidity crunch condition. So the liquidity adjustment facility is very important for the health of the banking sector and for the health of the economy, where inflation targets could be managed. So friends, now it is time to go into some factual matters. Liquidity adjustment facility was first introduced in US financial market in 1917. In India, Narsimham Committee on Banking Sector Reforms recommended for liquidity adjustment facility. A interim liquidity adjustment facility based on Narsimham Committee recommendation was introduced in 1999, but full force liquidity adjustment facility was actually introduced in year 2000, though it was revised in 2001 and 2004. One more interesting fact to be noted here is that when the scheme was introduced first, then the repo options or repo auctions were the options which sucks out the liquidity from financial market or liquidity from economy, and reverse repo was the option which pumps in the liquidity into the economy. However, the international nomenclature was just a reverse of that. So in October 2004, the Indian liquidity adjustment facility was made in line with the international nomenclature, and uses. So we can say that such thing only can happen in India. One more fact I want to discuss with you friends is that since October 2013 and June 2014, RBI also started term repo, and term repo has time limit of 14 days, and they have also started a term reverse repo which has a time limit of 56 operational days. So it is very important that repo and term repo, these are two different terminologies or two different concepts. So friends, term repo is the liquidity adjustment facility for particular span of time, but the normal repo, just a repo, is liquidity adjustment for overnight liquidity situation for the bank. So this is the very important difference to be noted here. I hope friends, I have made some efforts to make you understand the liquidity adjustment facility and concept related with it. If you have any doubts, please write us in the comment box. So this is the end of this video. Till then, goodbye, have a good time. Thank you friends.